So now you see my screen normally. Is that right?
Yes.
Okay, so we can start. And let us move to where we were yesterday. So yesterday we started the discussion about project evaluation, and just to summarize what we have done, I reminded you the usual criteria used in corporate finance to value an investment project, typically the NPV approach. But I also insisted on the fact that using the NPV just like this was not quite appropriate in project finance because of the complexity of these projects, and particularly the complexity of the financial schemes used to finance these long-term capital-intensive and risky projects. Okay, the complexity of the financial schemes makes it very difficult to have a clear idea of what the WACC, the weighted average cost of capital, is. Mostly because there are different types of instruments, and it is sometimes very difficult to make a distinction between equity and debt. Also, the idea is the capital structure is changing over time. You start with certain type of instruments which are there in the early phase of the project because there is a lot of risk, and then we move to another kind of instruments, no recourse debt, which is totally different with a different cost. So you see the concept of WACC is difficult to apply because it is changing over time and its evaluation remains tricky. I told you that there is a solution if you still want to measure the value created by a project rather than the NPV. Well, we could use the APV. And the APV to a certain extent is easier to use because remember what we do, we isolate the debt impact on the value creation. You look at the net present value of future operating cash flows, free cash flows, okay, by using the cost of equity, assuming zero debt, okay? And then after that, to take into account the fact that debt creates value, because debt is cheap and is tax deductible, then you calculate the tax shield, that is the tax saving you obtain because the cost of debt is tax deductible, and you value this tax shield, okay? And I told you also that we could expand the APV by adding all type of items which are constituting a source of revenue for the project, but which may be evaluated with a specific discount rate, okay? Well, the last point I mentioned is that another criticism of the NPV or even the APV approach is the fact that these criteria don't take into account the flexibility of a project, whereas it counts a lot for in project finance, because whether a project can be adjusted over time when new information are coming or not, well, it makes a difference. Indeed, a very flexible project, because there are different options attached to it that allows you to adjust your position depending on what you observe in the future. Well, this creates value. This flexibility creates value. It creates value because if you have flexibility, it means you have options to adjust, to do things which would adjust your position and create value. Okay, so the idea is to value this flexibility through the real option approach. And the real option is just as any other option. It is a right to do something, but not the obligation. Okay. The only difference between real option and traded option is that real option have no price on the market, and therefore they are very difficult to value. So the idea is not so much to try to assess the precise value for real options and integrate that in the value of the project, but to try to identify all the options, the real options that exist, all the possibilities that in the future will allow investors to adjust their position and take advantage of new information. Okay, this is behind this flexibility issue, you have indeed the possibility to adjust to new information. So even though you may not be able to value this, to quantify this precisely, it's important to identify all these options and maybe to consider that, well, the NPV may not be quite the right element because there are other things to take into consideration, and it may orient your decision. Even if you have no value, you might decide, for instance, to invest in a project with a rather low NPV or APV, okay? But considering the options which are attached, there is an extra value. You don't know exactly how much it is worth. You don't know exactly what this value is, but it may lead the decision maker to say, okay, let's go for it, because whatever the value will be high enough to, let's say, lead to a global value creation that would be acceptable for the project. Okay, so this is basically what we've done yesterday. Now, I told you that there is another difficulty which we have to deal with, and we are going to discuss that now, which is that most of the project, when it comes to project finance, are what we call offshore projects. Offshore projects, it means that for investors, for those who are bringing the money, okay, usually they would invest abroad, not in their local, not on the local market. Then it may happen indeed, but you know, those who participate in this type of large infrastructure project, usually these are global pool of investors, okay, coming from different nations with different currencies they take as a reference, and therefore it adds to the complexity. So which are the major questions we will have to discuss in this context? There are three issues to discuss, I told you. Well, what about the cost of funds with multiple currencies? Okay, it's indeed important to know how much it will cost to finance the project, but what if you raise a mixture of dollars, of yen, of euros, or maybe some let's say Chinese currency also? So how are you going to calculate the cost of funds where you have some nominal interest rates which are different from one currency to the other? So here we have a technical point to deal with, and we are going to start with this. Okay. The second point will be, how are you going to evaluate a project if your home currency, I mean, your home currency, which is important in terms of communication, financial communication, because if you are a European investor, if you invest, for instance, in Vietnam with cash flows in Vietnamese dong, you will not report cash flows in Vietnamese dong in your consolidated account. Okay, so all that will be translated to euros. So you see, you have obviously a foreign exchange risk, and we need to discuss how to treat that point. Okay, well, and last but not least, when you invest for an offshore project, it means that you are investing your money in another currency, but also in another country. And this country might be a risky country, particularly when it comes to infrastructure, because the main infrastructure development which is taking place in the world today, the main part of infrastructure development is taking part in the emerging world. Okay, and in the emerging world, we can accept the idea that there is a kind of economic and political and social instability that creates a kind of specific risk, which is what we call the country risk, which one way or another needs to be integrated, and we'll see that this is not always quite easy. Okay, so we are going to go through these three elements, which is an additional complexity to the valuation of the project as far as project finance is concerned. Okay, so let's start with the cost of funds. So you have this slide, but actually there is another slide which I have here. So I will make sure that you have the final slide, the complete set soon, because I have added few slides, and this is one additional slide to my presentation. Okay, it's very similar to the first one, but with a bit more explanation. So the first question we are going to deal with is how to determine the cost of capital if funds are raised in foreign currency. Okay, I want to first of all to a reminder, because these are concepts you are normally familiar with, will remind you the difference between nominal and real interest rate. let's assume that in a country you have a nominal interest rate, which is 5%. That is, if you borrow money, you will have to pay 5% interest. If you borrow 10,000, let's say, euro at 5%, it means that you will have to repay at the end 10,000 euro after 1 year plus 5% of it. Okay? Well, but what if you have inflation? Let's assume that inflation is 2%. Okay? I insist here on the fact that when we say inflation, you have to be careful. Don't take historical data for this type of analysis, because what counts is inflation that will prevail for the year to come. If you consider borrowing on a 1 year horizon, with a 1 year maturity, okay, you will have to pay 5% interest rate in 1 year from now. So what is important to see is what will be the inflation for the coming year. So it's not the inflation of last year, but it is inflation anticipated for the year to come, which means that this is more or less subjective. Okay, there is usually a consensus on this. That's where the 2% would come from, but it's not an objective data observed in the past, because what counts is the inflation for the future, what we call the anticipated inflation. Okay, then the real rate would be what? The idea is that in fact, if the nominal rate is 5%, but if you have 2% of inflation, in fact, the real rate is low, as you know, is lower than this. Basically, if you take an approximate, it will be roughly 3%. That is 5% minus 2%. Okay? How to explain this very, very, very quickly? Why 3% instead of 5% with a nominal rate? Well, let's assume, for instance, rather than borrowing, you invest your money. You invest your money, you get 10,000 to start with, and if you have 5%, it means that you will have 10,500 euros at the end. Okay? So, but what does it mean in terms of purchasing power? If prices have increased by 2%, the purchasing power of your 10,500 euros will have decreased by 2% over the year. So your real increase in income, your real increase in purchasing power, if you have invested your money at 5%, will not be 5%, but in terms of purchasing power, your gain will be only 3%. Okay, that's the meaning of it. Okay, and indeed, for economic decisions, what counts is the real interest rate. And for instance, if you look at the situation as it is now, real interest rates are mostly negative, okay, because we have very low nominal interest rates with just a bit of inflation. So we may have even negative real interest rates, which makes borrowing very attractive indeed for economic agents. So this is an approximate, as you probably know. Let me remind you the true value of the real rate. The normal, actually, the normal equation is this one, 1 plus the nominal rate is just the product of 1 plus the real rate time 1 plus the inflation, as you probably know. Okay. In other words, if I take the formula a bit differently, if you want to obtain the real rate, you should just take 1 plus the nominal rate over 1 plus the inflation rate. So that if we look at our example here, the real rate, if you want to be very rigorous, is not 3%, the difference, but more precisely, it will be 2.94. Okay, so that's just a reminder about this difference between nominal rates and real rates, and we needed that to understand how we are going to proceed to calculate an average cost of funds when we borrow in different currencies. Okay, so let's look how it works. And let's take a very simple example. A European invests in Vietnam and decide to borrow local funds at a local rate in Vietnamese dong, which is 13%. But if you assume that as a European investor, the currency of reference will be the euro, then the question for the investor is, what would be the equivalent rate expressed in euro terms? Okay, what this means, 13% really in Vietnamese dong, is not the investor is not concerned with Vietnamese dong, he's concerned with euros. So it would like to have, let's say, equivalent rate, the equivalence of 13% in Vietnamese dong in euro terms. We are going to assume here that anticipated inflation in Vietnam is 10% and 2.5% only in the Eurozone. These are not realistic data as of today, but I just wanted to make sure that the numbers are large enough for the sake of clarity in my presentation, okay? So what are we going to do? Well, to obtain this equivalent rate in euro terms, this is the formula we are going to use. So look at what we are doing. What do you have in this expression? The first block here is just the expression of the real interest rates in Vietnam. If you have 13% nominal rate in Vietnam, but if you assume that inflation will be 10%, okay, then the real rate would be obtained using this formula. 1 plus the real rate in Vietnam would be this, okay, which means that the real rate in Vietnam should be close to 3%, okay? So now once you have the real rate in Vietnam, it means that the borrower is borrowing in real terms at close to 3%. So what does it mean in terms of nominal rate in Europe? Well, now you need to add the impact of inflation in Europe, okay? So starting from the real rate in Vietnam, we now apply the anticipated inflation rate in Europe, which is 2.5%. And we obtain 1 plus 5.3%, which means that borrowing at 13% in Vietnam is equivalent to 5.3% for a European investor. Okay? And you'll see that this approach is useful to calculate the cost of funds when you have funds in different currencies. Okay? So what is the meaning of that precisely? Well, it's rather easy to understand if you have in mind the so-called PPP theory, purchasing power parity theory. If you borrow in Vietnamese dong, it is apparently less attractive because you pay 13% rather than an interest rate in Europe, which would be lower than this one. Okay? But is 13% that high? It may not be high if the value of your debt decrease, if the Vietnamese dong is depreciated. You know, if you have an interest rate, well, but if the dong is depreciated, it means what you have to repay in terms of Vietnamese dong will be less in euros. Okay? So the question is, why would the Vietnamese dong be depreciated against the euro? Well, the reason would be that if you have more inflation, and this is the reason why the interest rate is higher in Vietnam, it's because inflation is higher. Okay? The 13% nominal rate in Vietnam basically is influenced by the fact that you have a high level of inflation, which is reflected in the cost of funds in Vietnam. Okay? So if you have more inflation in Vietnam, what might be the consequence of this? Okay? The consequence of this might be a deterioration of the balance of trade of Vietnam. Okay? And if you have a regular deterioration of the balance of trade in Vietnam, what's going to be the consequence of that? You have probably seen that in other courses with my colleagues in economics in particular. Okay? Well, if you accumulate year after year deficits, trade deficits, because your prices are moving up more than in other countries because of your local inflation, then this trade deficit accumulated year after year will lead to a depreciation of your currency. In other words, if the PPP theory prevail, okay, if you accept it, okay, well, then you can say that if there is a difference in inflation, well, there will have probably an adjustment of the exchange rate. In other words, you see, if the PPP theory works, then you would have an exact compensation. Okay? In other words, you will have an adjustment of the exchange rate that would reduce your debt, the value of your debt, so that you can say that borrowing at 13% in Vietnamese dong is equivalent to borrowing at 5.3% in euro terms. Okay, the difference being explained by the fact that you will benefit rather than paying 13%, you will pay 13% interest in Vietnamese dong, but since the Vietnamese dong is depreciated, you will pay less. You have a compensation coming from the reduction of your debt due to the depreciation of the foreign currency, of the Vietnamese dong in this case. Okay, and that is the basic idea which is behind this approach to calculate an equivalent rate of interest in euro in comparison with a nominal rate which prevailed in Vietnam here at 13%. And it's based on the idea that the PPP theory applies. Okay? Well, does it apply in real life? In the short term, not so much. Okay, because there are all types of other flows, not just trade flows, but also capital flows and speculation and so on, which in the short term perturb and creates volatility on the foreign exchange market, so that the PPP theory does not apply in the short term. But it is well accepted that if you have a long-term view, which is typically what we have in project finance, because we're looking at long-term capital-intensive projects, well, we may consider that purchasing power parity theory makes sense if you have a long-term perspective. Okay, so if you accept this, now we can look at a more complex case. Okay, so now let's consider this situation. You have a project which might be wherever you want in the world, but you have investors and lenders, in particular from different countries. You may consider that you have Japanese banks, for instance, bringing part of the amount needed in. Here, I'm assuming that you have 100 million yen, which will come from Japanese banks. You also have some European financial institutions. They would bring 1 million, okay? And you have US financial institutions bringing $2 million US, okay? And we are going to take the US dollar as the home currency, okay? In other words, we look at the project which cash flow in US dollars, and therefore we need to have a cost of funds expressed also in US dollars. So you see, here it's tricky because we have three currencies, okay, with different interest rates. How can you add up all this? How can you calculate an average? What is the average cost of borrowing? Okay. What do you know else? Well, you have the exchange rate at the moment. The present exchange rate is $1 is equivalent to 100 yen, and $1 is equivalent to 0.9 euros. Okay. And indeed, $1 is $1. What about anticipated inflation? You can look at Reuters or any other type of financial institution providing information about the consensus on inflation for different countries. Well, let's consider that the inflation for the years to come in Japan would be around 0.2%, whereas in Europe it would be 1.5%, and in the US it would be 3%. Okay, so now these are the data we have, and how are we going to do to calculate the average cost of borrowing? Well, first of all, let's look at the weight of each currency in the total borrowing. Now we are going to translate, because the dollar is our currency of reference. We are going to transform all these amounts in dollar amounts. Okay, so the yen, considering the exchange rate, it would correspond to $1 million. Okay, if you take the euro, it will be 1,111,000 something. Okay, and if you take US dollars, indeed you have 2 million. So altogether, you have a total of 4,100,000 and 11,000, 11. Okay, so now we can calculate the weight of each currency in the global borrowing. The yen would represent 24.3%, the euro would represent 27%, and the dollar would correspond to nearly half of the total amount, more exactly 48.6%. Okay, we have the weight now, but we need to calculate an average cost. So what are we going to do there? Well, actually, since the dollar is our currency of reference, we are going to try to see for each currency, for each nominal rate, what is the equivalent rate in dollars? Exactly, following exactly the same formula which we have used in the previous example, to calculate the equivalent rate in euro, starting with a 13% nominal rate in Vietnam. Okay, so please look at my slides, because I've made an adjustment on what you have on the slides you have in the document, in the document you were provided with. Okay, so please look at what I'm showing you right now, and please take note. Okay, so let's look at this table. I'm using the formula. Okay, I can come back to the formula we had before. I'm using this formula which you have here to find the equivalent rate, okay, in the currency of reference, which is the dollar now. So based on this formula, I have this table. So if you take the yen, what is the nominal rate for a Japanese? 2%. What is the anticipated inflation in Japan? 0.2%. Then you look at the fact that in Japan, the real rate is 180. Okay, so if you have a real rate of 180 in Japan, what do you need to add now? You need to add the inflation, which is expected in the US, which is 3%. Okay, so based on the formula you had before, I can have this conclusion that 2% as a nominal rate in Japan is equivalent to 4.85% nominal rate in US dollars. Okay, I will have the same approach for the euro, but now the nominal rate is 5%. The anticipated inflation is 1.5%. Okay, then if you make the calculation using the previous formula, you find a real rate in Europe, which would be 3.45%. Now I will add to this real European rate the American inflation, so that I will obtain an equivalent rate of 5% for euros to an equivalent rate in dollars, which will be 6.55%. Indeed, for the portion of the loan which is in dollars, there is no problem. Okay, you have 6% of nominal rate, and the nominal rate remains 6% indeed. So once we have this now, we have, the nominal rate expressed in dollars for each of the borrowing tranche, for the tranche in yen, for the tranche in euro, and for the tranche in dollars. So now we can apply these nominal rates for each tranche using the weight which we have here to calculate the weighted average cost of debt. And we find an average cost of debt which is 587, okay, which is a mixture of these three tranches with all the nominal rates locally transformed into equivalent rates in dollars. Okay, so I insist, these are the right values. If I remember well, you must have a mistake on the document you have. Okay, so please take notes of this, and I will make sure that you get this slide very soon. Well, so now let's move to the next issue concerning offshore project. How to deal with the foreign exchange risk and inflation. I look at both foreign exchange risk and inflation because indeed they are kind of related. For the reason we mentioned before, basically. If you have a high inflation in a country, higher than in other countries, okay, then in the long term, you can expect that the currency would depreciate against the other currencies, okay? In other words, the inflation gap is the difference between the local inflation and the inflation outside, has an impact on the trade balance. And if the inflation gap is not favorable, that is, if you have more inflation in your country, it will deteriorate your competitiveness, and you can expect that the trade balance will deteriorate over years. If the trade balance deteriorates over years, it means that you import more than what you export. If you import more, it means that you need to buy foreign currency and to sell your currency to pay for the import, okay? And it will contribute to increase the supply of your currency on the market, okay? And indeed, an increase in supply of a currency will contribute to the decrease in the value of this currency on the market. Okay, well, so there are different situations. Let's assume, to start with, that you can hedge your foreign exchange risk exposure. You know that there are some hedging instruments which exist. You can use options, swaps, all types of derivatives. I'm not going to explain that to you because it would be the topic for other courses, and probably some of you had the opportunity to study all these things in depth. Then if you have this possibility, you can take the investment decision without considering future exchange rate movements because you have a hedge, okay? You have a perfect hedge. If you have a perfect hedge, then there is no problem because there is no foreign exchange risk. You just have to take into account what? Well, either you predict your cash flow using the currency of the country where the project is developed, and then discount with reference to the cost of capital in this country. Okay? So, and then if you have an NPV in a foreign currency, well, indeed, if you use the foreign currency, you have to use for your evaluation a discount rate that makes sense for this country, which is appropriate for the currency you are referring to. In other words, you have to take the cost of capital in the country where the project is developed, okay? And indeed, you can then transform if you have, let's say, an NPV, you can transform the NPV into your local currency using the existing exchange rate. Well, either you take the forward exchange rate to predict future cash flows, okay? For instance, if you have currencies, if you have a project that generates, let's say, cash flows in dollars, if you are a European investor, okay, you have a forward rate for the dollar that would give you the proper reference to transform a cash flow in dollars in the future into a cash flow in Europe today. But if you have a perfect hedge, then it makes sense to take the forward rates to transform your cash flow in a foreign currency into a cash flow in your own home currency. Okay, so these are the two solutions. Okay, well, one problem is indeed that it may not quite apply to the type of situation we are looking at. You see why? Because you probably know that it's difficult to find a hedge for long horizons. You know, if you have short-term elements to hedge, well, it is feasible because you can use forward market in particular, or options or whatever, or swaps. But you know, there are no solution for long maturities. The maximum would be 2-3 years, and still, for 2-3 years, the market is not liquid at all. So we would say that to have a perfect hedge, it's only for very short period of time, which is few months, not much beyond 1 year horizon. And therefore, it's not quite appropriate. I just wanted to mention this situation, but it's not quite appropriate for our case, okay? Because of the long maturities we have to deal with. Anyway, there is a kind of remark that needs to be done to start with. When you invest in a foreign country, okay, and in other words, then you are concerned by the foreign exchange risk. Well, the decision to invest should normally, I say normally because it's not always the case, be separated from the decisions to hedge the foreign exchange risk. Okay? Whether you want to hedge or not, okay, that's a decision taken by the company. Some company would say, we don't want to have any volatility coming from that because it's not our job. We don't want to disturb our cash flow statement, okay? So we want to hedge. Some other companies would consider that the foreign exchange risk might be a source of profit, and then they may have a team of traders playing with that and considering that it's part of the business and it might be a source of profit. That may be the case, but it should not, whether you hedge or not, it is an independent decision. It shouldn't have an impact on your decision to invest in a project or not, okay? So it should be separated from the decision to hedge the foreign exchange risk or not. A good investment should not be affected by the fear of a currency depreciation. If there is a good investment to be done in a country, well, even if you have a fear of a depreciation, you should not just decide not to invest because you have the fear of depreciation. Nor should you count on a currency appreciation to justify a bad investment. Okay? Well, so now let's look at the situation which is more in line with our type of situation if we have a long-term horizon and if hedging is not possible. Then again, I will refer to the PPP theory. PPP stands, I remind you, purchasing power parity theory. It's a bit ambiguous because we also have PPPs, public-private partnerships, so it's nothing to do with that indeed here. So now let's consider this case. A European investor, for instance, let's assume you are a European investor and you are exposed to a foreign exchange risk if you invest outside the Eurozone. Okay? Because let's take an example which is an easy one for you to understand how it may work. Let's take the retail industry. Large companies such as let's say Carrefour. You probably know Carrefour, which is one big French retailer with investment all over the world. And let's assume that Carrefour invests in Brazil. Actually, they are in Brazil. Okay, so they have a project which is over there, and their cash flows indeed locally are in the Brazilian currency, which is the real. Okay, so Carrefour is exposed to a foreign exchange risk. True, because actually, since the cash flows are in the Brazilian currency, if there is a depreciation of the Brazilian currency, then they have also a depreciation of their cash flows expressed in euros, and the euro is the money, the currency they use for their account. Okay, so they have a foreign exchange risk. Okay, they would be happy indeed if there is an increase in the value of the Brazilian currency because they would have a higher amount expressed in euro. Okay, but is it a real risk for them? Okay, because if you say, well, there is a risk of a depreciation of the Brazilian currency over the years to come, then the question you should raise also is, why would we have a depreciation of the Brazilian currency? Well, for the economists, there is one answer. We might have a depreciation of the Brazilian currency if there is a high inflation in Brazil. For the reason we mentioned already, if you have a high inflation in a country, it contributes to the deterioration of the currency and its price. Okay, so there is a close link. Okay, due to the purchasing power parity principle, there is a close link through the trade balance between inflation in one country and the evolution of the currency. So you see, is Carrefour really exposed to a foreign exchange risk? Not so much, because, okay, the Brazilian currency could deteriorate, but the reason for that would be a high inflation in Brazil. If you have a high inflation in Brazil, it means prices are going up. And it means that the sales of Carrefour will increase with inflation. So, the sales would increase, which means that this increase might compensate for the currency depreciation. And if the purchasing power parity works well, okay, if it does apply, if you consider it applies, then you can say that they will have a perfect compensation between the two phenomena. In other words, the loss you experience due to the depreciation of the currency, if the PPP theory applies, is perfectly compensated by the increase in sales due to the high inflation in Brazil. So this is what we call a kind of natural hedging. You don't need any instruments. You have a kind of natural hedging, which is due to the PPP principle. Okay, so if that applies, if you can consider that you are in a situation where, you know, the PPP theory applies, then there is no foreign exchange risk and you can just forget about it. In other words, you will take for your cash flow statement the foreign exchange rate at the moment when you invest, okay, and you will apply this rate to transform all your future cash flows into your local currency, okay? Because if there are movements of the foreign exchange rate, you know it will be compensated on average by the evolution of your sales. Indeed, that is true only if the PPP theory applies. I took the example of Carrefour because it is a typical case where it does apply. But I can tell you that at Carrefour, those who are responsible for that, they count on this to balance their foreign exchange risk. And they don't need to have any type of policy to hedge, actually, because they know that to a certain extent, they, even if it's an approximate, well, they can count on this PPP impact to be covered against the foreign exchange risk, okay? So if the theory, PPP theory is assumed to be true, which tends to be the case in the long run, you can analyze the project on the basis of free cash flow expressed in your own currency using the current exchange rate, okay? A depreciation of the foreign currency would result from higher inflation in the foreign country, meaning also higher cash flows. So if PPP theory applies, there is an exact compensation, okay? The problem is that there are situations where the PPP theory does not apply. So if you consider that it does not apply, it's not relevant, then you need to imagine different scenarios reflecting how exchange rates and inflation may affect the project cash flow. So you need to make simulations and try to see what might be the volatility generated by the fluctuation of cash flow. When in which case, for instance, it wouldn't apply? Well, you know, if you look at the inflation impact on future cash flows, you may have, let's say, a chemical plant. They would sell their product all over the world, okay? Or even in a local country, okay? So you can count on the local inflation that would affect the sales, okay? But maybe they have to buy commodities and let's say raw materials, which are expressed in other currencies, in dollars, for instance. That you may have an inflation which applied to the project just because of an inflation due to the price of commodities, okay, which it has nothing to do with the inflation in the country where the project is located. So in this case, you have a kind of disconnection between the local inflation and how your sales will be applied and the evolution of the exchange rate, okay? Because the inflation you are exposed to is not only a local inflation, it's also an inflation that may come from your supply, which might come from outside the country where the project is located. So in this case, the PPP theory would not apply. And what you have to do there is to make certain simulations, as we have done before, to try to see what would be the range of values and what would be the volatility generated by the movement of exchange rate. And it's difficult in this case to hedge, so that you have to accept the volatility. Or if you think the volatility is too high, then maybe you can imagine some types of solution to try to get a kind of natural hedging. One way to hedge also is on a long-term basis is to borrow money in a certain currency to create liabilities in a currency, okay, that would compensate for the volatility of some asset you have in another currency. Okay, so you can use on your you can play on your capital structure, you know, it's a kind of asset liability management in this case, just to compensate some fluctuations. Well, now the next the next problem we have to look at, we have discussed the cost of debt. We have discussed the issue of the foreign exchange risk. Now there is another point we need to look at is what about the cost of equity? Okay. If you invest in a country which is not yours, okay, what type of procedure can you use to determine the risk premium? So excuse me, this is not the right slide. I suggest you move directly to the next one. Okay. Project evaluation, the case of offshore project, how to determine the equity risk premium. Well, here again, you have different approaches. You have at least two approaches. One which is what we might call the multi-country portfolio approach, or another approach which I call the single project approach. The multi-country portfolio approach has a strong theoretical relevance, but as we'll see, it's not quite easy to apply in practical terms. So the first case is to adopt a global perspective. What does it mean? It means that you will consider that you are a global investor. If you are a global investor, it means that you have projects all over the world. And there are some large companies which are typically in this situation. Okay? So how are you going to determine the cost of equity? In other words, when you want to determine the cost of equity, the problem is to determine the equity risk premium. Okay? So if you are a global investor, your reference, you need to find a reference for the market you are going to use to calculate the beta and the market risk premium. So if you are a global investor, you cannot take any one local market as a reference because it is just local. Okay. So ideally, you should take into consideration the global market. That is the aggregation of all local financial markets. Okay. Does it exist? Yes, to a certain extent. You have, for instance, the Morgan Stanley Capital Index, MSCI, okay, which allows you to calculate, to use the CAPM in a global context. In other words, to calculate the beta of your project, you will try to assess, to look at the link between the volatility of your project and the volatility of the global index. Okay. In other words, in a global perspective, you use the CAPM with reference to a global market index. That's it. So it's just a basic approach of the CAPM with a particular case because you are looking not at the local particular market, but at the global market. This is not so common. Another approach would be to have what we call an international perspective. International perspective would be a bit different. In this case, for instance, you consider you are, let's say, an American investor. You are not a global investor, you are an American company, you are an American investor. Your reference is the American stock market. Okay? So you will take this as a reference. Okay? And then if you invest in another country, you will have to combine the project beta and the target country beta. In other words, let's assume that an American would invest in Vietnam. Okay? The reference for the American investor might be the Standard & Poor's market index in New York. Okay? Well, then the first thing to look at would be to see what is the volatility of the Vietnamese stock market with reference to the S&P. So you have a first beta, which will be calculated by the international investor, which is the beta of the Vietnamese market with reference to the S&P New York. Then we will now look at the project itself located in Vietnam and see what is the beta of this project with reference to the Vietnamese market. Okay, Vietnamese stock market. So in other words, the beta you are going to use to calculate the equity risk premium would be the combination of the beta of the Vietnamese market with reference to the S&P time the beta of the project located in Vietnam with reference to the Vietnamese market. Let's say, for instance, that the beta of the Vietnamese market with reference to the S&P would be, let's say, 0.8. Okay. Let's assume now that the beta of the project with reference to the Vietnamese market would be 0.9. The beta taken into consideration to calculate the risk premium, the equity risk premium, would be the combination of these two beta, which is 0.8 times 0.9, which would be 0.72. Okay. And then taking the market risk premium prevailing on the American market. Okay, this is what I call the international perspective, which is different in the sense that we still refer to a local market to start with. Okay, so these are the two, the most relevant approach if you refer to the theory. I would say that from a theoretical point of view, normally the global perspective should prevail. Okay, but practically the second one is very often used. Okay, but what is still more often used, even though theoretically it is not quite justified, it is what we call the single project approach. Okay, and it corresponds to a managerial relevance. What is the problem behind? You know, if you have a project in Vietnam with a project company launched for this, as we said, the reason for having a project company, it's just because you want to isolate the project and have a very strong control on it to follow exactly what are the cash flows generated by the project, how much money is spent for this project, and so on. So you have a team which is dedicated to this and a team which is responsible for that. So the team in charge, you know, is really much focused on this project. And therefore, the team is not diversified. It's very difficult to tell to those who are in charge of the project, who will be responsible for the performance of the project, to tell them that, well, they should forget about this project because it's only a minor part of a very global portfolio for the company. No, these guys are responsible for their project. And for instance, if there is a country risk in particular, they would like to take account of this particular risk because they are facing this risk personally. Okay, so in a single project approach, you have the CAPM which applies again, but you would also have a country risk. Okay, so you take the CAPM, okay, and you have the country risk. So what does it mean exactly? How does it work? Here, just a remark: the single project normally results in higher rates. Due to higher risk premiums, this diversification effect is not fully integrated. You see, if you had a country risk, it means that you are not really considering that the company has a global portfolio in many different countries. If you integrate fully the one country risk, it means that you are not taking account the diversification effect. The fact that the company has a global portfolio with many countries in its portfolio, and then the country risk can be diversified away. Okay, but if you have this single approach, then you tend to overestimate the risk premium because you don't take really into account the country diversification, the geographical diversification. So to be more precise on that, how does it work? So you see, I've tried, you don't have this slide, but to explain to you typically the type of approach that is used both in the international approach or in the individual approach. You see, you have an investor's local stock market. You have the local stock market where the project is located. Okay, So you have a beta between the two stock markets, and you have a beta between the project and the local stock market. So these are the elements to have in mind to understand how the equity risk premium will be calculated. So excuse me, because my slides, I just realized that they were displaced. So now I come to this slide, which is actually the following. I will change this. So now let's look at this slide, which is an explanation with a bit of detail of how the case of the, let's say, the individual country would be the focus. Okay. And it is, I just show this one because it is the most used approach to calculate the equity beta. So the cost of equity would be the risk-free rate of the home country for the investor. Okay, so if you have an American investor, this would be the risk-free rate that prevail in the US. If you invest in Vietnam, you would have a country spread. Okay, your country spread. What is it exactly? Well, you look at the spread on the Vietnamese bonds, okay, which you compare to the spread of, let's say, of similar level of risk in the US, okay? So that, and there are data which you can obtain from Reuters, for instance. Damodaran is also providing a lot of data about this to calculate an adjusted country spread, which is actually a kind of spread between what the spread would be in your home country and what it is in the country where you invest, which is a kind of measure which is taken as an indicator of the country risk. Okay, and then you will use an adjusted beta, which you will apply to your market risk premium at home. So if you are a US investor, you will look at the market risk premium, let's say, on the New York stock market. What does it mean, the adjusted beta? Well, it is the project beta to start with, time the local market beta with reference to the home market. In other words, this would be the beta between the Vietnamese stock market and the Standard & Poor's. Then it's a bit tricky, but usually we had a correction factor. I am basically explaining the process used by Damodaran, and I do this because, and you have again the reference down there, because Damodaran is a very current reference. I'm not telling you that it is a perfect reference. I just tell you, and that's why I'm explaining exactly how it's done, just because it is a very common reference. I'm not sure it is quite relevant, but you have to know that it is commonly used. Okay, so a correction factor of 0.6. Why? Because, you know, the country spread, which is taken into account to calculate the country risk, includes the country risk, and the country risk is also included in the volatility of the local market. You know, so if you don't correct the volatility of the local market, you will count twice the country risk, which is already in the country spread. So what you need to do, following Damodaran idea, is to make a kind of estimate to take out of the local market volatility what is due to the country risk. And according to Damodaran, you need a correction factor of 0.6. Don't ask me why it is 0.6. Damodaran is good at providing numbers, okay? But well, now, to which extent these numbers are quite reliable, that's another story. The idea is always to say that it's better to try to have an approximate number rather than doing nothing, okay? So the correction factor, if you take Damodaran with 0.6, correction factor of 0.6, because country credit spreads explains part of the local market volatility, about 40%, okay? In other words, you will take only 0.6% of the local market beta, okay, 60%, sorry, of the local market beta, because there is about 40% of the market volatility, which corresponds to the country risk, which is already taken into account in the country spread, okay? So if you want an illustration now, here I'm looking at a European investor. So if the risk-free rate is 4%, if you have a country spread of 2%, which would correspond to 200 basis points, if you take a market risk premium at 5%, the project beta, let's assume it is 1.2, and then the local market beta with reference to the European market would be 0.4, then the cost of equity would be 4%, which is the risk-free rate, plus 2%, which is the country spread, plus 1.2, which is the project beta, time 0.4 times 0.6, which is the adjusted local market beta, times 5%, which is the market risk premium. And you would obtain 8.88%. Okay, this is a bit complex. I can understand this, but it is a kind of approach which is very much used if you want to calculate an equity, the cost of equity. And you have the reference, the web link, which you can consult if you want to know more about this. Okay. So now I would like to conclude this discussion about the cost of equity in particular, and about the idea of global diversification. Because you see, it's true that, as I said, if you are responsible for a particular project, you are the one who is responsible and you are not personally diversified. From a managerial point of view, you don't really feel the diversification because you are facing the risk in the country where you are. Now, the question is that quite relevant to integrate the country risk fully when you develop a project which is part of a large portfolio project for the investors involved in this project? I would like to show you that it might be misleading because in this case, if you really focus on one country without considering this country as part of a geographical portfolio, then you ignore the diversification effect. So let's look at this company. This company is called CFAO, which stands for Compagnie Française d'Afrique de l'Ouest. It used to be a French company. It is now a Japanese company. Okay. You can see their activities. They are mostly in, let's say, in retail activity, distribution, and they would distribution all types of goods, equipment, okay, and services. Also in the healthcare industry, pharmaceutical products, and they also distribute consumer goods with different entities all over the world. Not all over the world exactly, but mostly in West Africa. And you can see on the map here. Okay. And when you look at these countries, you know, they are probably among the riskiest countries in the world. You look at Algeria, Angola, Burkina Faso, Cameroon, Congo, Cote d'Ivoire, and so on. If you look at the news, you know, these countries are very, very unstable. And if you look at the country risk rating, well, you would see that they are considered as very risky. So when you look at this, if you observe that, we say, well, that's totally crazy. How can you go and invest just in these very risky countries? If you look at the level of risk for these countries, I'm using here a scale of risk assessment, which comes from COFAS. COFAS, which is a French company, Compagnie Française d'Assurance Crédit. She provides credit insurance, okay, and because they provide credit insurance, they are interested indeed in country risk, and they provide risk rating for all countries all over the world. So they have a rating here. If you are A1, it means that your risk is very low. If you are a country rated E, it means it's an extreme risk, okay? And I have added numbers 1 for a very low risk, and 8 for the highest possible risk. Okay, if you look at the country where the company is invested in, you have the list here. You see that most countries are either in C or D. Most of them are between, and C and D, you see, it's either high or very high. Okay, you even have some countries which are in the E. If you're in Central African Republic, you know, the rate for the country risk is E. Okay, and for the business climate, you know, most countries are D or C also. Okay, so how can you understand such a portfolio of activities? You know, if you look at each of these activities, maybe except for a few which are rated, let's say like Morocco, where you have an A4, which is acceptable risk, you know, but most are really with at least a significant risk, and many of them with a high or very high. Okay. Each country individually is risky for sure, but does it make sense to have an individual approach? Well, indeed, should adopt a portfolio approach, because the question is, what if you have a portfolio of all these countries, which is the case here? Well, actually, it's easy to understand what's happening. There are, I don't remember exactly how many countries here, but let's say about 20 countries, okay? Maybe continuously, you have at least 5 or 6 of these countries where it's a total mess, where the company is not doing money at all, they even lose money. But in the other countries, because they have a strong position, they make a lot of money, okay? So indeed, regularly, even if it goes well in a particular country, it may, after a few years, being a total disaster because you have a political coup or whatever, and the economy is down and you lose money again. But in countries where they are doing bad, maybe some years later, well, the country is recovering with a new political party, with a bit of stability, and then the company, because the company remains during the tough period, immediately when it starts again, they are there, they have a strong position on the market, and they make a lot of money. So you see, it's not always, you can say that on average, they are losing money in 5 or 6 countries continuously, but they make big profit in the rest of their portfolio. So it's not always the same country where they make money or where they lose country, but on average, they are making a lot of money in 15 countries and losing in 5. And altogether, they earn money, you see? And this is exactly what you observe. If you look at the data we have here, you know, these are the results for this company for the period for 2000, 1999, if you like, and 2015. You see, the average growth for the company doubled that of African GDP over the past 15 years, okay? And if you look at the increase in sales, it was 8% per year. You know, it's very high. It's much higher than the growth rate that took place during this period in Africa, particularly also because during this period, you had the global economic crisis that took place in 2007, 2008. If you look at the operating margin, you know, the operating margin is rather stable, okay? It is slightly decreasing. Why? Because inevitably you have more and more competition, particularly in this part of the world, competition from the Chinese companies, okay? But they have been able to maintain a quite reasonable margin, you know, which is close to 7.8%. Many companies would like to have such an operating margin, okay? The only drop in sales which you have here happened when? In 2009, 2010, okay? Particularly in 2009. It is the direct consequence of the global crisis. And if you think of it, the global crisis that took place, that occurred in 2009, is what we call a systematic risk. That is a risk that cannot be diversified away. That's exactly what the CAPM tells us, okay? The only risk that counts really is the systematic risk, because you can't avoid it. And in this case, CFAO could not avoid it. That's why you have a drop here, okay? A drop here, which is due to the fact that all over the world, you had a reduction in economic growth and in economic activity, okay? But if you look at it, globally, in the end, it looks safe. In other words, you start with a kind of observation which is very pessimistic. You say, well, how can you do business in these very risky countries? Well, just because of diversification, the risk to a certain extent disappear within the portfolio. It's only the systematic part of the risk that does not disappear, and you can observe it in 2008. Okay, but otherwise, the business is safe. You have a safe business with operation in more than 20 very risky countries. That's a very good illustration of the diversification effect you can benefit from if you are diversified geographically. That's why, it is not quite relevant to include and to give a big weight to the country risk when you invest in a particular country. Why? Because the question is not whether this country is risky. The question is, are you well diversified globally? If you are doing business in many different countries, okay, well, the country risk tends to disappear within your portfolio. Now I have to be honest, because I took an example which is a very specific type of example. Okay? If you consider this, actually, this is a service activity. It's mostly retail and distribution. There is no manufacturing. There is no huge amount of capital invested to produce. Okay? There is just a bit of inventory and few facilities necessary for the retail business. So if the business is interrupted, you don't have huge fixed costs running. That's why also this activity is viable, even though the countries are risky, even though you might have a huge volatility of sales. Okay, it wouldn't be the same if you have a chemical plant with a huge amount of money invested. The story would be a bit different, but still, it doesn't mean that you should not consider the geographical portfolio when you make a choice for a particular project in a particular country. Okay. Well, so because the country risk is very often taken into consideration in the analysis of a project, of an offshore project, well, I think it's reasonable to have a short focus on country risk analysis, how it can be done, and so on, because that is a key element in project finance, to analyze the risk you take within a country. Even if it can be diversified away, still you will hesitate to invest a huge amount of money in a capital-intensive activity with assets which will be blocked there with huge fixed costs if the level of the risk in the country is considered too high. So now the next step will be to look at the basic principle of country analysis. But I'm just looking at my watch. It is 10:15 for me, so I think it's the right time to take a break, 15-minute breaks, if you don't mind. Okay. I think it'll. Okay. So see you in 15 minutes. Ouais, je vais prendre. Are you there? Yes, okay. So all of you are back? Okay, so, well, so as I told you, if I summarize what I've just said, just before the break, if you have a large portfolio of country, indeed, you have to consider that you may benefit from a geographical diversification. And the case we have looked at, CFAO, is clear about that. Now, nevertheless, and particularly if you have to invest in heavy infrastructures with huge capital cost and assets which are blocked in the country, indeed, it's a bit of less favorable situation to benefit from diversification. And just because you have the fixed cost still running, and it may lead to huge losses if your business is interrupted for any reason. Okay, so the country analysis would remain, in any case, an important point in the project development to see whether the project is viable, acceptable or not. Okay, so considering that point, I thought it was useful to have a close look at what we mean by country analysis. Okay, how do we, what are the specialists providing you with ratings and opinions about the country risk? What are they doing? What type of analysis are they developing? So this is the aim of this section. Well, basically, there is a very simple idea to start with. If a country is doing well economically, it probably means, it certainly means that this country is not too risky. When things are going well, it means that people are happy. You don't have much instability is going on. However, if things turn out to be bad, if the economic situation is tough and so on, then you have a demonstration, you have social movements, you have political instability. So a bad economic climate goes together with a higher risk for the country. That's kind of obvious. So to look at the driving factor that will have an impact on the level of risk, actually, you have to look at let's say, the quality of the economic system, how it works. And there are two things you have to look at. A country which is doing well, actually, is a country where you have a sustained demand. Consumers are ready to buy, investors are keen to invest, and so on. And in front of this demand, you have a competitive supply. So if you have both a sustained demand and a competitive supply, it means that there is a strong demand that boosts the economy, and at the same time, you have also the companies that can provide what people want to buy. Not only they can provide what local people want to buy, but they also usually have a capacity to export to boost further their activity. So it's important, if you want to assess the level of risk of a country, to look at all the factors which have an impact on either demand or either competitiveness of supply. So let's look first at demand. What do we mean by demand? You probably remember I assume you know your basics in macroeconomics. When we talk about demand, what does it include? It includes C, which stands for consumption, E, which stands for investment. Okay, investment is a demand for capital goods. Consumer would buy consumer goods such as food, clothes, or cars, all type of equipment for the house, and so on. Well, investment, it's a bit the same, but rather than buying, let's say, food, well, you would buy raw materials to process in your company, okay? Or you will buy new equipment, new machines, new robots, and so on to develop your competitiveness. So, but it's still a demand. I mean, it means you have behind that, you have an economic agent willing to buy from someone else, from a supplier. Well, then you have G, which stands for government expenditures. The state more or less plays a role in the economic system, more or less, I say, because it's very different from one country to another. The government in particular will have to invest in infrastructure, for instance, to develop new universities, new hospitals, to develop in communication networks and so on. These are spendings which come from the states, which are included in what we call here G. Well, and then you have what we call the external demand, which is X minus M, and X stands for export and M for import. So you look at the difference. X is indeed a demand which comes from outside. Okay. M is a local demand which is not addressed to local companies, but which is addressed to foreign companies. So it's a kind of leak outside the country, whereas export corresponds to an additional demand which comes from outside the country. Okay. So if you have a trade surplus, well, it means that you have a net demand from outside. If you have a trade deficit, you have a part of your local demand which is not a demand for your local companies, but a demand for outside players. Okay, but these are the components of what we call the global demand. Okay, so what are the factors which have an influence on it that analysts, country analysts, would look at? For each, there are different elements to take into consideration. Consumption, for instance. One very important factor would be confidence in the future. If people are not quite confident in the future, they tend to save. Okay, to save money rather than consuming, and it would, in this case, bring consumption down. It will reduce demand, and companies might be less willing to invest. Okay, demography is also a major factor. When you have young people, they like to consume, whereas if you have an old population, that this old population tends to reduce its consumption because you have everything you need at home. You don't need to buy other things. Maybe you can replace sometime, but not so often. So you tend to consume less. So a young country would generally consume more, which actually is the case now in Vietnam. Okay, well, income, the level of income, indeed. If you have a rich country with a high income per capita, so it means that people have the power to spend. Okay, but it's not only the GDP that counts, the global GDP for the country. And the GDP per capita is only an average. What also counts is how it is, let's say, distributed. The repartition of the income in the country is also an important point. If you have many poor people and few very rich people, that's not good for consumption. Why? Because very rich people, they consume everything they want, but if they get more money, they're not going to spend more because they already have everything they want. Okay, and if you maintain a large part of the population with in a situation of severe poverty, it means that these people, they are not going to consume. Okay, so even if you increase the GDP, if the GDP is not going to the right pockets, well, it may not have much impact on consumption, and which is indeed a key problem in many countries, particularly in emerging countries right now, where not everyone benefits from growth. Okay. Well, another point which is important indeed is access to credit. If you want to spend now, if you can count on an income in the future, if you are optimistic, particularly when you are young, you start in life. Okay, you may need to equip yourself with cars, home equipments, and so on. So an easy access to credit would facilitate consumption. That's typically the case in the US, for instance, where there is traditionally an easy access to credit. That's why the level of consumption is so high. It's one of the reasons why consumption is so high in the US. Also because these guys are very optimistic about the future in general, so that they don't hesitate to borrow money right now. They are so sure that they will be able to make it in the future and then to repay their debt. And it is seen as an easy way. Okay. The problem that it may lead to situations which are tricky, and remember in 2008, the very reason for the crisis was the fact that many people had borrowed money to buy their house, and actually they couldn't repay their loan. And then this was the trigger of the crisis we had in 2008. Okay, but these are, maybe we could have other factors, but these are the main factors that analysts would look at to try to anticipate to which extent consumption will drive the economy. What about investment? Well, the investment is made by companies, okay? So they will look at the cost of funds first. If you have a high cost of funds with high interest rate, real interest rate in particular, well, they might hesitate to invest. Anyway, you are familiar with that. You know that the cost of funds will have an impact on the WACC. If the WACC is high, then less projects will become viable and investment will go down. So it's just this very simple reason which is considered here. Well, investment will also depend a lot on anticipation. Companies will decide to invest if they are optimistic as to their capacity in the future to sell and to grow their sales. Okay, and within a country, the part of the investment, particularly in emerging countries, and that's the case for Vietnam, for instance, lots of investments are made by foreign investors. In other words, it's a contribution of FDI, which stands for, as you know, foreign direct investment. Okay, so if the country is attractive, then it's a kind of consequence of the good quality of a risk. If the country is not too risky, then it is seen as a successful country where you can expect growth. Well, investors which come from outside and will boost demand. So it's a kind of positive loop. What about G? It totally depends on the budget policy. Okay, whether the government is ready to spend and has enough tax money to spend. Okay, and that may be a problem in emerging countries where the tax revenues are usually a bit too short to provide all the money needed for the government to develop new public services or new infrastructures which are nevertheless necessary to continue the economic development in the country. That's where, for emerging countries, it's a tricky issue on one side to develop infrastructures, but on the other side, sometimes it is too early in the emerging phase for the government to collect enough money and enough tax revenues to finance these investments. So that might be an issue, and that's where project finance has a role to play, because as we said, one of the major advantages of project finance for governments is the fact that it's a way to attract foreign investors. Okay. Well, what about X minus M, the net export, as we call it? Totally depends on the global economic situation. If you have a global crisis, then demand from outside will decrease. Okay. If you have a rapid growth all over the world, then any country would benefit. Okay. But it depends also on the international openness. If you are open to foreigners, North Korea, for instance, doesn't benefit so much from the outside world, considering its high level of closeness. Okay. So these are the main factors concerning demand. Now, if you have a strong demand, if there is no competitive supply, then it means that all should be imported. And imports, which is part of the net outside demand, import is just a leak. Okay, and then that would be a major problem in the country, because if you have a strong demand with no capacity to provide locally, well, you have a huge trade deficit accumulating year after year, which leads indeed to a deterioration of the situation, starting with a depreciation of the currency that would make imports more and more expensive, and therefore you can expect inflation and the like. Okay, well, so the conditions for things to go well, it's not just to have a strong demand, but it also you also have to count on a competitive supply, either to satisfy the local demand or also to be part of the game on the global scene, to have a capacity also to export. Okay, so what are the conditions for a competitive supply? What about you have cost? Competitiveness can come from low cost or cost in line with what is to compete properly on the global market. Your capacity to innovate, indeed, and to provide new solutions and to attract new customers, or to improve your competitiveness through more efficiency in the production process. Access to finance. Okay, if you want to innovate, you need to finance new equipments, new projects, and so on, and you need to have access to finance. You need to get easy money, and that depends indeed on the level of development of the financial system in the country, and it also depends on public action, which can favor more or less the supply development, the development of firms, their capacity to innovate, and their capacity to raise money. So when you look at cost, what are the major aspects which are going to be considered? Inflation and foreign exchange rate. Okay. If you have more inflation, as we said already, your competitiveness will deteriorate. Okay. And if you have depreciation, that usually it goes together of your foreign exchange rate, it means that what you have to buy from outside will increase. For instance, if you need to buy energy outside, oil in particular, or commodities, it will cost you a lot and generate even more inflation in your country. Okay. Then you have to look at the two things together: productivity and wages. It's not too much of a problem to pay higher wages if you have a high level of productivity in your companies. Okay, because if you have a high level of productivity, it generates, the resources that would allow you to pay well your people. Okay, so the problem is not the level of wage in itself. It's a level of wage compared with the level of productivity in your country. If you have a high level of productivity, higher than in other countries, well, you can pay your people well without deteriorating your competitiveness. The problem, and it is a major problem for emerging countries, it's to be stuck in what we call the middle income trap. I don't know if you are familiar with this concept. The middle income trap is the fact that in emerging countries, when you start growing, usually you start to have a strong demand for labor, for qualified labor, and you observe an increase in the cost of labor. If that increase in cost of labor, if at the same time you don't have an increase in productivity, then you end up with a kind of gap between your level of productivity and the cost of labor. You have a cost of labor which is too high in comparison with the productivity level. Okay, and in this case, your competitiveness deteriorates. And that's the origin of the middle income trap. Emerging countries start to grow. They tend to increase the income per capita, and it translates into higher wages. But this may not be followed by an increase in productivity accordingly. In this case, you have a deterioration of this, let's say, positioning in terms of productivity and wage that deteriorates your competitiveness so that you are stuck at your level without being able to progress further in your development. Okay, so this is the relation between productivity and cost of labor is a key element to look at. Indeed, taxation will have a role, okay, because it will have a direct impact on the cost of companies and efficiency of markets. What do I mean there? If you have a country where few players would control crucial markets, such as the market, for instance, for commodities, for certain crucial kind of goods, okay, which are needed for all companies, actually, that might be a problem because it would be a handicap for local companies. And it happens typically when you have some, let's say, some local strong networks of people who have the capacity to control some key aspect of the economy, with monopoly positions, handing with very high prices and high margins for the few people at the detriment of the rest of the economic system. Okay, there are many countries like that, just because there is a kind of, let's say, it goes together usually with a high level of corruption. Okay, where you have few people controlling the whole system, and this is at the detriment of the competitiveness of the rest of the economy. Okay, as long as you have this, well, it will be difficult to grow further, and this is a major problem for some countries, and it is considered as a major source of risk indeed for the country. It's a major weakness. So innovation, then you have to look at the R&D capacities and level. Technology transfers also play a major role, particularly in emerging countries. And this is also, as we said, one major advantage of project finance, because for a complex project, usually you have the contribution of foreign, let's say, companies with a strong expertise in the field. They will employ and they will train local people, and it will be one way for the country to increase its technological capacity. Okay, so technology transfers are major element to develop a competitive supply in emerging countries. If you think, for instance, in countries like Korea, typically, Korea some 20, 30 years ago was an emerging country in the very early stage of emergence. It's the best example I can find to explain the efficiency of a good way of dealing with technology transfers. The Korean have been probably the best example you can mention to show how a country can benefit from technology transfers. Okay. Ease to do business is another important thing. Is it easy to do business? Well, sometimes you may have what we call the red tape. Red tape is when you have a very heavy bureaucracy, putting a lot of constraints and norms and rules, difficult to handle for companies, and that may be an obstacle for the development of a competitive supply. No need to say that for a country like Vietnam. I think you would agree with me if we say that maybe there is an effort to be made to reduce let's say, the bureaucratic aspect of some of the activities in Vietnam. And I can say that because I know that even Vietnamese would say the same. And flexibility, that is the capacity for the companies to move from one activity to other, to restructure. And that depends a lot of legal elements, legal aspects in the country. Access to finance. It has to do with the efficiency and the depth of the financial market. Okay. Efficiency and depth of financial market, that is the possibility for locals to find quickly the money they need in good conditions. Okay. And that, of course, necessitates an evolution. Let me remind you that when we launched the MEBF, the very reason for that was to try to boost the expertise in the banking system, typically to contribute through this type of training to improve the efficiency of your financial system and banking system in particular in Vietnam at a moment when it was absolutely necessary. Okay, but indeed it will depend also on local saving. If you have a lot of local saving, then it would be easier to raise funds in good conditions, because local saving means cheaper local money. Otherwise, you have to count on outside investors, okay? Outside banks, for instance, or financial institutions such as pension funds, for instance. We'll see later on that pension funds are very much interested in project finance, because they would contribute particularly for the no-recourse debt, which is included in the financial package of project finance. Okay, but this also depends on the country rating. You see, so good, and the analysis leads to a conclusion as to the country rating. But the country rating in itself contributes to the quality of the country. Okay, because if you have a good country rating, it will be easier to get money from foreign investors. What about the public action? Institutional stability is a key element, particularly for foreign investors, and they play a role through FDI, through the provision of funds when needed. Okay, it's always reassuring to see that within a country you have a political stability, because the institutions are there, and even if there is a crisis, if the institutions are strong enough, well, you can go easier through a crisis. So it's a strength, for instance, which is often mentioned for Vietnam, with a strong political party at the head of Vietnam, which even if there is a bit of bureaucracy, still it's behind that you have a certain stability, which is highly appreciated by investors. Relevancy or efficiency of public policies. That's indeed, it's not always easy to say what is efficient and what is relevant, because economists might disagree on this. Let me just give you one point. When it comes to the efficiency of public policies, this is indeed one point which is analyzed by analysts when they try to assess the country risk. The public policies will have an impact, for instance, on the ease to do business. So it has an impact on companies directly. Okay, and what we have to say is that there is a kind of ideological bias in most of the analysis. Why? because it appears that the more liberal a country is, the better it is appreciated by analysts, considering that behind liberalisms, you have the idea of ease to the business and easy access to markets, better regulation with more competition, and so on. So there is obviously a kind of bias based on the idea that a market-driven economy with a kind of liberal policy behind it would be the best situation that could prevail within a country. Indeed, that could be discussed. That's not the point here, but I just wanted to mention that bias which exists, obviously. Education and health are key elements, okay? Why education? Because education has to do with the capacity of the local people to develop their own technologies, to benefit from technology transfers and to innovate. And health is also important because when it comes to, these are both contributors to happiness. There are lots of surveys concerning the happiness in each country. And you would see that people, when they are more educated, and if they can count on a good health system, they are usually happier than in other countries. Okay? So if they are happier, it means they are more optimistic also. They would invest more, they would consume more, and it is all beneficial for the country. The rule of law is also a major point, which would have to do with the ease to do business mentioned before, okay? And the rule of law is really a key element. According to, we'll see later on how this is, with the opinion of analysts concerning your country, and there are some comments indeed on this aspect. So here I'm giving you see, so there are many factors to be considered. The idea being that if for a country you have a strong sustained demand because there are all types of positive factors playing, the same for competitive supply, that the country is doing well and the risk is very low. But if you have, for all these factors, or for many of them, some weaknesses which are there, well, indeed, it will be a major obstacle for economic development, and it usually corresponds to a local situation which is unstable with tendency to deteriorate, that might lead to some political crisis and the like, some political instability, and indeed that would contribute to deteriorate the risk rating of the country. Okay, so now once we have said that, how are analysts doing their job? Well, they would take all these criteria and usually rank them in terms of large block. Okay, and I provide you with a typical classification that would be used by analysts. Okay, and you would recognize in each of these blocks the different factors which I have referred to in the previous slide. One first block would be the economic activity. You look at the GDP per capita, which is a kind of idea of, let's say, of capacity to spend in the country. Economic growth, which tells you the degree of success of the country. But it's not only economic growth that counts, the growth, where are the growth drivers? If in the country the growth rate is high because they produce oil and there is a stronger demand for oil, and if the country is just producing oil, you may have a high economic growth, but the growth driver is not quite sustainable. Okay, so what are the growth drivers and what are the leading industries? Are they in areas where you have a bright future, or are they in areas where we can expect that the markets will decline? In this case, it's not the same story, okay? And productivity and wage, I told you, is a key element to see how is the country positioned in terms of competitiveness, particularly labor cost competitiveness, okay? So all these data can be found in national accounts, in the World Bank, at the OECD, regional development banks, and so on. All these data are available. So in the last column, I indicate the major sources of data which analysts would use. And for some of them, I even indicate some precise indicators. The second point would be openness and international exposure, okay? How is the country doing in the global system, okay? One source of information is the current account balance. I guess you are familiar with the balance of payment. So the current account balance will tell you everything about what is imported, what is exported, what about the services, also whether the country is exporting services as well as goods and so on. What are the capital flows in terms of foreign direct investment and also saving coming from outside to feed the local financial market? And what about the currency reserves, which will tell you the capacity of the country to control its exchange rate? Okay, so these are the main elements that would be considered if you look at the openness international exposure. So indeed, a surplus of the current account balance, capital flows with money coming in the country, but also capital flows going outside, meaning that the country has also a capacity to take control of companies outside, would tell you about the strength of local companies. And currency reserves also is a kind of signal of good health if the currency reserves are high enough, and the reverse indeed if they are too weak. Well, then you look at the financial system, the banking system and financial inclusion. Then here you have all type of documents which can be found from the central banks first, the IMF, International Monetary Fund, the Bank for International Settlement, and the World Bank would also provide a lot of data concerning these things. You look at monetary policy and inflation. Inflation is indeed an important point. And capital market efficiency, which is also a point that will tell you to which extent companies can count on this local market to raise the money they need for their investments. Then you have a block usually which corresponds to public finance, where you look at public spending, okay? In which area? State-owned firms. Considering the bias that I was mentioning before, it is considered that the less the state is involved in terms of intervention, direct intervention in the economy through the control of firms, the less they're involved, the better for analysts. Is that something that everyone can accept? That's another idea, but it's a commonly accepted idea. Tax collection, what is the capacity of the country to collect taxes? And that's usually a problem for emerging countries, because in the early phase of development, people are not used to pay tax. And when you start to have a tax system, it is well known that many people will try to avoid paying taxes. I don't know if it's still the case, but I remember that in Vietnam, when you introduced the VAT system, when going to the restaurant, they were just asking you whether you wanted to pay with VAT or without VAT. And if you need to have an invoice to get your money back from your company, then you will have to pay the VAT. Otherwise, well, they would accept you not to pay that because they didn't realize how important it was to pay taxes. I think it has changed a bit, but this is typically the type of behavior you see in many emerging countries where people have not fully integrated the fact that paying tax is a necessity to contribute to the economic development of the country. Public debt, the fiscal balance, then after that you look at the fiscal balance. If the fiscal deficit is too high, then it will be a problem inevitably in the future, okay? And again, I insist on the importance of project finance here, because project finance, I repeat, is a mechanism that allows the use of private funds to finance public infrastructures, okay? And even though these are complex structures to develop, with a lot of difficulties, particularly with PPPs, when you have public-private partnership, nevertheless, it may contribute a lot to the development of local infrastructures, and it's good particularly when the state is a bit short of tax revenues. So indeed, recurring fiscal deficit will contribute to the accumulation of public debt. And when you look at the public debt, well, it's not only the amount of the debt that counts, okay, but it's the weight in comparison with the GDP, which is the traditional ratio which is taken to assess the level of public debt, but it's also the origin of the funding, okay? If the public debt is financed by local investors with local money, local saving, it's an internal problem, okay? The problem is if the country has borrowed in foreign currency from foreign investors, okay? Because then there is a high risk, because would the currency depreciate, the local currency, in case it would depreciate, well, then it means that the value of the debt would increase dramatically sometime, okay? And it's exactly the situation that occurred in countries like Argentina, for instance, or Venezuela, because part of the debt they had was in dollars, okay? And all of a sudden, due to the depreciation of their currency, well, the value of their debt expressed in the local currency increased dramatically, which led to unsustainable situations. Okay, so that for the public finance block. Usually after that, you have a block that concerns the social climate and the environment. So you look at the demographic structure. Do we have an old population, aging population, or young? What about unemployment? It gives you also an idea about the level of activity in the country, and also an indicator of, let's say, social tensions. If you have a high level of unemployment, well, it's not quite good socially speaking. What about the educational system? Is it doing a good job or not? What about equity? If you have a lack of equity in the country, well, it may be the origin of, let's say, social movements. What about the quality of life, community tensions, geopolitical tensions? Okay, community tensions, that's typically what you have, for instance, in India. That's a major weakness for India, as well as geopolitical tensions for India with the problem with Pakistan, for instance, to a certain extent, with China also. So, you know, India is, on these 2 points, for instance, would be very badly rated, okay? I give you the some indicators that exist for each HDI, for instance. It's a Human Development Index, NPI, BLI. You will have the meaning of this element on the next slide. And finally, usually you have some indication about the business environment. You would look at the stability of institutions, okay? State of law. What is the level of corruption? Ease to do business, market efficiency, availability and quality of infrastructures, innovation capacity, you know? And for all these things, you know, it gives you an idea about how easy and how efficient it is to do business locally. Okay, you have a lot of indicators which are mentioned here, which comes either from the World Bank, from OECD, or a lot also from the World Economic Forum. Okay, so you see here what you find, it's typically very similar to what we had here, but it's classified into big blocks. And these blocks basically corresponds roughly to what most analysts would do. You have different institutions providing many institutions, banks, other financial institutions or credit agencies, providing country risk rating. They all have their own methodology, but it always corresponds to something like this. So they may have different types of classification, but usually you would find all these items, okay, in the criteria considered. Okay, here you have the meaning for the, you see, I mentioned here some indicators. On this table, you have exactly what it means, and you have the origin with the website in case you would need to have a look at it. Okay, one important element is the ease to do business. A lot of people would look at this, which would play a major role, you know. And it, I recommend, if you have a bit of time, to look at the detail of the ease of doing business, which include a lot of things, which would include, for instance, the state of law, the bureaucratic burden, and all these things. So now, how are analysts doing? Okay. So you see in my presentation, we had, let's say, 6 blocks. Okay. So an analyst would do the same. They have blocks, which they have defined as I did. Okay. And as I told you, and I repeat, the blocks they have basically corresponds to what the categories I have presented. And they would typically do something like this, you know. They would give a grade to each of these dimensions. For instance, for the one which would be the economic situation, which was the first category I've considered, well, you see that within this category, you have different elements. if I come back to, for instance, my table, you have the GDP per capita, you have the economic growth, growth drivers, leading industry, productivity, and wages. For each, you can give a kind of rate, saying, well, GDP per capita is rather high, so it would be a good point. Economic growth is good also. Maybe leading industry would be a bit more negative because the leading industries maybe don't have much, you can't be much optimistic for their future. So for each of these elements in block one, you would be able to give a rate based on a way to assess, which you have developed, a rate to each of these elements. So having done this, for instance, for the group one, after you have taken into consideration each element within group one, then you would say that the grade is 3. These are pure assumptions indeed. Well, if you do the same for each block, then you would obtain a grade here. Okay? And weight, you could consider that some elements are more important than others. Okay? Here I have assumed, which is very often the case, I have assumed that each category was equally important. Therefore, the weight of each will be 16.67%. Okay? And I can define a risk profile, okay, which is using a type of graph which you know perfectly, which you have seen many times, okay, and which give you an idea of the position of the country for each of the criteria you have defined, okay? And you can also calculate a rate, which would be an average that you would take if you have the same weight for each category, then you have a weighted average, which would be 333. Okay, that's a very common practice. So now, few comments about this. Beware. Why? It is nice graph. You know, you have a number, and many people love numbers. Okay, they love numbers because they like to quantify things. How risky a country is on a scale between 0 and 5, you have an answer 333. Okay, which you can compare to another country which is maybe 332. Okay, or 2 or 4. Okay, so it's nice, but you have to be very careful. And to be frank with you, risk analysts provide this type of documentation because, you know, they want to show that they do something, that they end up with a kind of information that you can use for your decision. But be careful. What about the quality of sources? Okay, there are many indicators which are built. Okay, you have to go deep into the indicator to have a real understanding of what they mean. So you have to be careful with that. Okay, and sometimes, you know, the sources are kind of global. They are based on the opinions taken from. It's typically the case for corruption index, for instance. You know, the corruption index is based on the opinion given by people doing business in the country. You know, is that absolutely relevant? The problem also that if you want to develop a particular project, you know, a particular project, you may have some aspects which are not well reflected by the global country assessment. You may, for instance, have a very huge bureaucratic burden in a country. But it is quite feasible that within this heavy bureaucracy, you may have one ministry very efficient because they are used to work with foreigners, and it would be very easy for the investors, okay, to develop a particular project for which the bureaucratic burden is not that big. The only way to solve that is to find local partners and try, which you can rely upon, or if you have some people who are already installed in the country on which you can count to have reliable information, then it's always interesting to ask to try to get this kind of individual or personalized information, okay, in addition to what is provided by all the large institutions such as World Bank, OECD, or IMF, and which is then, let's say, engineered to provide a rate at the end by the analyst. Okay? Subjectivity, yes, as I told you, there is always a certain subjectivity. For instance, when you say that the grade will be 3 for one aspect or 2, why 3, why 2, why not 2.5? You know, don't forget that numbers are there, but most of them, they remain highly subjective, okay? Another point is additivity. When you take an average, it means that you take the weighted average of the sum. You take the sum here and you divide by 6 because we have 6 criteria. Okay, so you have additivity because you had all the rates and then you divide. Okay, but you could perfectly consider that for one particular, let's say, indicator, you would say, I would not invest if this indicator indicates a level of risk higher than a certain threshold. For instance, you might say that for category 4, I would not accept the project if for the category 4, the index is lower than 3, which is the case here because we have 2.5. In this case, even though the global rate, 333, looks acceptable, okay, nevertheless, you might reject or decide not to invest just because you would say no, because on one criteria, which I consider is most important, the index shows a rating which is below what I am ready to accept. So additivity, indeed, it's an issue, but indeed it can be corrected because you can have your own approach and say, when you look at the detail, no, I will reject that because for the category 4, I'm not happy with that. So the answer is no, whatever the rate on the other categories. Weight, I gave equal weighting here, where indeed some criteria might be given a higher rate. Well, there are some cases where you can do that online. You can have access on the rating, kind of rating software, where you will have all the indications for the grades, and then you choose your weight. Okay, and you calculate your own rating based on your own weighting system. But indeed, it also remains subjective. Why would you say that this category should be 50%, this one 20%? Well, that is also to a certain extent subjective. And a question you should ask, numbers are comfortable and it looks highly scientific, so you have the impression that you are taking a more rational decision. Okay, and when you numbers are very powerful. Well, but you should always raise the question, do you need numbers at all? Okay, so it's important to have the global analysis, to have a global look, and then you need to make a decision. It remains subjective anyway. Don't believe that just because you have a number, it becomes objective. No. Behind that, you have subjectivity in the quality of sources, in the way you decide the weight, in the way you allocate the rates, and so on. Okay? So rather than just focusing on numbers, then maybe it's better to say, well, globally, the risk seems acceptable or not acceptable. This would be subjective indeed, but not more than relying on a number, and it is probably less misleading. You have subjectivity, let's accept it, and let's play with it. So I give you an example, and indeed I took the example of Vietnam. It's a bit old, I should update my data, but it's just to illustrate. So what do you have here? That's a very common type of note for a country analysis, where you have strengths and weaknesses. And when you read this, you will see that the remarks here, the notes, corresponds to the elements which I have mentioned in my presentation. Strengths, for instance, low wages but relatively skilled workforce, which means that there is a good balance between wage and productivity. Competitive manufacturing hub, okay? It means that you have a competitive environment that contributes to more efficiency, okay, in Vietnam. And it is seen as a hub that is attracting foreign investors to produce in Vietnam and then to export in other countries. So it means that the Vietnamese economy can count on strong export demand. Development potential of various natural resources, especially minerals and so on, which is a kind of guarantee for the country to get the supply they need in good conditions. Relatively open economy, so that's a degree of openness, with growth model based on trade. Okay, so it is seen as Vietnam is seen as an open country, and therefore which can benefit from the global trend. Ongoing shift towards higher value-added sectors, meaning that not only the country is growing, but it's growing with a focus on the growth drivers, which we have mentioned as an important factor to analyze the country. Ongoing shift towards higher value-added sectors, which means that the country is not progressing only in value terms, but also in the quality of the workforce, which is more and more skilled, and also on the level of sophistication of the activities with higher value-added sectors. Nevertheless, there are also weaknesses: lack of transparency, which is not good for people who are willing to do business. It would deteriorate the indicator ease to do business. A fragile and opaque banking system that would be seen as a source of instability, which might disturb the economic system, okay? And also opacity very often relates to corruption. Infrastructure to be improved, okay? That's a weakness, and that's why when you see that, that's why project finance is so important, because it might be the solution to develop your infrastructures. A complicated business environment. It has to do with, well, the bureaucratic dimension of the Vietnamese economy. High regional disparities in terms of development and rising inequalities. That may be a source of instability, okay? It is in the block of social environment. Low external reserves, which is a weakness in terms of controlling the exchange rate. Recurrent tension with China. This is also these geopolitical tensions, which I didn't mention in my general presentation. Okay, so if you look at strengths and weaknesses, you find all type of references to the major factors I have indicated. So you can use the presentation of the risk profile of the country, okay, here, and it would be rated C3, which is not a grade. C3 would correspond to a kind of average risk in the Euler Hermes, because this is an Euler Hermes schedule. C3 would be a kind of average risk, okay? And the different blocks they consider, you know, exactly as I have done in my general presentation. You have an economic risk, you have a business environment risk, you have a political risk, commercial risk, and financing risk. In this case, Euler Hermes would consider only 5 categories, whereas I did consider 6 in my presentation in general. But each institution providing country risk rating would have its own approach with its own categories, but it's always more or less the same element they would consider. Okay? This is C3, so that's just to let you know, it's a sensitive risk for enterprise. Strong economic performance marks structural fragilities. This is the conclusion for October 2019, so it's more recent. Okay, it's an update, kind of, with an economic risk which remain rather high, business environmental risk, political risk, commercial risk is in the green. Okay, so you see, you find roughly the same elements which we have commented before, with the minus and the plus here. Okay, so it didn't change so much between 2017 and 2019. Okay. Well, so I finished with the evaluation. Okay. And you have understood that all the methodologies which are used are derived from what you have seen in corporate finance when you have been looking at investment decisions. But what you need to keep in mind when it comes to project finance, well, it becomes a bit more complex because of the complexity of the financial schemes which are used, as well as the contractual schemes which are also put in place with a large number of participants, okay? And also the fact that the projects are developed at a global level with investors from many different countries, with many different, very often various currencies involved in the cash flow generation process, as well as in the funding. So this complexity obliged to go a bit further from the traditional approach of investment valuation with the techniques which I have provided, okay, typically the APV and also the real option model that would also contribute to add, let's say, a new dimension in the investment analysis, and also with an importance which is indeed given to country risk analysis, because infrastructure development concerns mainly emerging countries where the risk is considered to be traditionally higher than the level of risk you have in, let's say, mature countries. Okay, so I often mention the fact that the complexity came from the complexity of the functional schemes in place. So this is the next step we are going to tackle, which is indeed probably the most important step also. So let's move now to, strictly speaking, what we call project financing, okay? So before we go into the detail of the instruments which are used, let's come back to this graph which we have analyzed together already. On this graph, you have, with a gray curve, the curve that represents the uncertainty resolution, with a very simple idea. That is that when you start a project, there are many uncertainties, many things which you don't really know. Sometimes it is very complex, even if the job is well done, to have a precise idea of how much you will have to spend to complete the project, particularly if there are some, if you want to construct a large bridge or a tollway or a tunnel, where you may find some conditions which were not anticipated, which would lead to huge extra costs, okay? So you have a lot of uncertainties, and indeed these uncertainties will be resolved over time, okay? And when the project is completed, I mean, when the infrastructure are built, a lot of these uncertainties have been resolved. That's why you have a decrease over time of this uncertainty to reach a kind of low level of uncertainty when you start the development phase, okay? That is the operating phase, if you like, okay? The red curve indicates the progression of the capital invested, okay, which I call the capital employed there. You start here, and progressively, once you complete the project, you need to spend money to invest in the equipment, to build the facilities, and so on. And then when it's done, then after that, you have a kind of decrease, okay, of this capital employed if you assume that your assets needs to be depreciated, okay? Well, there is one thing that I never considered, but which should be considered in certain circumstances, is the fact that you may have to spend money again at the end for decommissioning. I didn't mention that point, but it's typically the case, and in certain type of project, typically, for instance, for a nuclear plant, because when you develop a nuclear plant, you should integrate from the very beginning the amount you will have to spend at the end when you will consider that the plant cannot be operated anymore, it has to be dismantled. This is a huge cost which need to be integrated. In this case, we would have an additional expenses that should be integrated here, and which in itself is a source of uncertainty. Okay, but let's avoid this complexity to start with. So I guess you understand well this. So now we can have a graph showing the risk exposure as we did already. Remind you, why do you have this profile for the risk exposure over time? Because, as I said, as long as you have no money invested, you have no risk. And the risk grow while you are accumulating funds invested in the project, whereas uncertainty remains high as long as the project is not completed, okay? So you have a peak for the risk exposure, okay? And then, indeed, the risk exposure will decrease because we go through the startup phase, and we can expect that when we reach the development phase, we just have the operations running normally, everything is well under control, and the risk is much lower. Indeed, I have to repeat that when I say that the risk is decreasing, it doesn't mean that the project is doing well. As I said already, if you start losing money, if you are sure about it, there is no risk. Risk has to do with the fact that you don't know actually what's going to be the future. Okay. Once you know, even if you know you lose money, there is no risk anymore. Okay. Well, so it's not, this graph is not showing that systematically the risk is going down and then you end up with the happy face. No, it may end up with a situation where you lose money, which means that in this case, the project could be interrupted earlier. Okay. But if things go well, after you have gone through this risky phase, well, then you have an operational phase where the level of risk is much lower. Therefore, you see that, as we mentioned already in the introduction, the first type of instrument you will use to finance a project will indeed be equity. Equity is brought by the sponsors, and they take the risk with the money they invest. They will be the first to lose if there is a loss due to failure of the project. Okay, so they constitute a kind of protection for the others. Okay, but the equity holders have a rather small contribution. Remember, it may be in the range of 30%. So the equity alone will not be enough to cover the risk for lenders during this very risky phase. That's why you don't want to increase the number of equity, because equity holders don't want to bring more money. Okay, but they need to attract investors who are ready to take risks during this transition phase, during this risky phase. And that's where you have the so-called mezzanine financing. We'll see the detail of what it includes. Okay, plus contingent facilities. I remind you what it is. It's part of the uncertainty element. You never know exactly how much it will cost to complete the project, to develop the facilities and to make the construction. Okay, and therefore you have to be ready to raise additional funds if needed, if the project appears to be more expensive than it was thought in the first place. Okay, so these type of instruments, as we'll see, are in between equity and debt. Okay, it is a kind of debt through which the investors are taking a kind of risk, to complete the risk, the protection provided by the equity holders. Okay? Indeed, the debt that will be used, the debt instruments which will be used as part of this mezzanine financing will be an expensive debt, because the interest rate will include a remuneration for the risk that lenders, this type of lenders, are taking. So we'll see more precisely what it includes. Well, what does it mean, mezzanine? It's a funny kind of name, I don't know if you know this word, what it means exactly. In a house, the mezzanine is a room which is a kind of place which is in between the ground floor and the first floor. Okay, you have a ground floor, you have the first floor, and the mezzanine might be somewhere in between. So here, it's just to say that the mezzanine debt, the type of debt you have here, is not pure equity, but it's a bit like equity, and it's riskier than debt, traditional debt. So it would be a kind of protection for the traditional lenders. Okay, this is a kind of risky debt, if you prefer, and this is an instrument which is in between traditional debt and equity. That's why we call it mezzanine financing. I'm talking about debt. It can be also a kind of equity. If you have, for instance, preference shares, as we'll see. Okay, so once the risk has decreased, well, we don't need to have this expensive debt anymore. There is no reason why we should pay an expensive debt if there is no risk anymore. So this debt will contribute to finance the project during the completion phase, usually during the risky phase. At the end of the risky phase, then we will use another sort of debt, which will come as a substitute for the mezzanine debt. In other words, the mezzanine debt may be a debt for a period of 3-4 years. Usually it's not clearly defined. It can be a debt that will be defined for 3 years with a possibility to move up to 5 years, because we know that the project, you might have delays, not only cost overrun, but also delays. So you have to anticipate also for delays, so that this debt has not a well-fixed maturity. Okay? And at the end, when the project is completed, when things are running normally, then the project company will borrow funds to repay the lenders, the first lenders. Okay? And you have a no recourse debt, which will be a substitute for the previous debt, but a substitute which also will be cheaper because the lenders are now taking less risk because we have started the low risk exposure period. Okay? And the no recourse debt, I remind you what it is. It is a kind of debt for which the guarantee essentially comes from the cash flow of the project. But it is acceptable because now the cash flow or the project are highly secured because we have gone through the risky phase and we are now in a kind of safe phase where risk is not too low, too high. So now in this complex kind of schemes, let's look at the different players. And let's look at the role of banks. I told you it's not just one bank involved, particularly for very expensive large project. You have a pool or a syndicate of banks. But what is the role of the banks? Indeed, we expect the banks will provide funds because we need money. But they also provide various services, a lot of other services, typically financial engineering. You know, in some cases, if you have very big project, you may issue bonds, specific bonds for this project. In this case, the banks would provide the issuing service, you know, to arrange all that. Structuring also the debt, providing the proper type of instrument that should be issued, okay, indicating which instrument to structure them in terms of delay, in terms of cost, and so on, risk analysis. And they would also sometimes provide some hedging solutions when hedging is seen as a necessity or a useful instrument. Well, importantly also, they are usually experts in tax optimization. That's why I didn't mention that, but when you look at the project company, sometimes you have many participants around and some connections with other subsidiary which might be in tax havens to optimize the tax, and banks would provide a service for that because usually they are themselves established in these tax havens. They would usually have a team specialized, and some banks are specialized in certain areas, you know, so that they can provide the risk analysis and the cash flow prediction with models and simulations which they have ready, okay, because they may have a strong experience in a particular field. For instance, for wind farms, there are some financial institutions which are very much specialized in that with a strong expertise, and they would provide indeed all the models and simulations necessary to evaluate the project and to analyze the feasibility of projects. And also they may establish a relationship with international organizations and local authorities. They have connections usually all over the world. The large banks, I will show you who are the major players in a minute. They may, for instance, have good relations or have contacts directly within the World Banks, for instance. The World Banks may decide to support the project if it contributes to the economic development of an emerging country or a developing country. And in this case, you know, the bank can provide the arguments and the data necessary to comply with the request of the World Bank in terms of transparency and in terms of information needed to make a decision, okay? And also with local authorities. The banks are established all over the world usually, and they have good connections with the Ministry of Finance usually, and then for a large project that would necessitate a cooperation with local authorities, well, the banks can be used as a local representative that would help to facilitate the relations between, I would say, the private investors and the local authorities. Okay, so you see, banks are not just providing funds; they also provide a wide range of services. Now, you have a different type of banks. Soft banks and are said to be arrangers. The arrangers, well, they would arrange, they would contribute to develop the proper financial engineering and contribute to the issuing and structuring of the debt. Okay, they are not just providing the funds. Okay, they can be arrangers or book runners if you have an issue of bonds. Okay, mandated lead arrangers or lead bond book runners, financial advisors, legal advisors. You know, they would play all these activities, which are services, which are added to just the provision of funds. So the banks which are selected based usually on their reputation. You know, some banks may have built a very strong reputation in certain areas, and particularly some banks are known for their strong expertise in project finance. Okay, and some of them are known, as I told you, for a specific experience in a particular field or a particular country. Okay. You have some banks, obviously, which will be specialized. A lot of Japanese banks would be highly specialized in doing business, for instance, in Asia, in the Southeast Asian region. Okay. And some of them might be also specialists in certain industries. And usually the arrangers will also contribute to the provision of funds, but mainly for the first phase, you know, when you have to structure with specific and complex type of debt instruments. Then at the second level, okay, level 2, you have a pool of providers. That is a pool of banks who will accept to contribute for a certain tranche to contribute to the financing. Okay, it can be a pool of providers to finance the phase 1, which is the risky phase, but they might also contribute later on to the refinancing of phase 1. The refinancing of phase 1 is the provision of funds, of loans, of no recourse loans in general, which will come as a substitute for the debt which was used in the first phase during the risky phase. Okay, and these providers, they can then refinance themselves at a third level from other banks. Okay, through all type of possibilities, typically securitization, for instance, and being used widely to refinance, for banks to refinance their initial loans. Okay, so that's roughly the structure that exists within banks, with the different roles to be played. And indeed, the arrangers and book runners would get the most of the fees behind that, and that's a rather good business for banks indeed. Well, I told you I would give you some indication about the big players. Okay, this was for 2018, 2017. Mitsubishi, you know, the China Development Bank, is doing a lot, particularly because the Chinese, as you know, are keen to develop infrastructures because they develop and they bring their own people to build and so on. You know the story. So it's not surprising to find the Chinese there with an amount of proceeds which is in millions of dollars, which is about 2 billion. Okay. ING, Société Générale, which is a French bank, you know, not doing that bad. Okay. And then the list of industry total, it was 39 billion, you know, in 2018. Okay. You have here, sorry, that was for mandated arrangers. So and you also have book runners. Book runners, it's when you issue bonds, because the project is usually then much higher. Then you have the China Development Bank, Sumitomo, and so on, just to give you some names which you will recognize here. So a few French banks, but you have a lot of Japanese banks which have a long-lasting experience in the field. You see Sumitomo, Mitsubishi, Mitsuo. You have a lot of Australian banks. ANZ is doing a lot also, usually, particularly because they have developed in expertise in developing mining project finance. So that's why they are there typically. Well, Natixis is French, BNP is French, so you find also a few French banks. Okay, so now what you need to know also that it takes some time, a long time, before you can have all ready to start financing the project. So here I take the example of the case study we have studied I've shown to you in the first place, which was SeaPower. And I just described here the financing negotiation process. It started in February 10. I don't remember which year. Okay. Key suppliers selected and detailed design finalized. That is February 10 of the year. I think it was 2000 something. I don't remember. Anyway, it's no problem. So let's start in February. So everything is ready. We know what we want to do. We have an idea of how much it will cost to develop the project. And we know who will participate. Okay. It is important to know who will be the case suppliers, because these case suppliers are known for their reputation. Okay. And they will have an influence on the perceived risk of the project. Okay. So unless you have this well ready with reliable suppliers with a strong expertise in the field and a detailed design of the project, so that the investors will make sure that they will feel comfortable with who is doing the job, and knowing precisely, they will be reassured to see that we know precisely where we go with a detailed design well finalized. So you start discussion on financing structure with the European Investment Bank and ECAs, which are export credit agencies. So term sheet preparation based multilateral rules and requirements. Okay. And then you end up here about with the approval of the financing structure by European Investment Bank and ECAs. So you get from the European Investment Bank and ECAs kind of guarantee, which will improve the quality, which enhance the quality of the debt. Okay, so then you can prepare the term sheet and the info memo. The RFP, which is the RFP stands for, sorry, I don't remember what it is. It is the reference. Well, actually, it's a reference document that will be prepared to identify the type of loan which are expected. Okay, so RFP preparation, info memo, term sheet. Okay, once you have the agreement of these central institutions providing you a kind of go for it with some guarantees, then it will be easier to tackle the debt market, and you prepare a document to tell the market exactly what you expect from them in terms of funding. So then you can select commercial lenders, okay? And then you have a mandate letter which is signed, okay? Negotiation with CL and multilaterals. CL stands for commercial lenders. Okay, once you have identified them, when you negotiate and multilaterals, which are the larger institutions. Okay. Then you have an approval, a committee that approve all commercial lenders credits, what you expect from commercial lenders is approved, okay, by your committee. Fine-tuning with EIB guarantees, and you have a financial clause where everything is set in terms of agreement of the money you will have the right to raise. Usually, you have the right to raise a certain amount of funds, okay, with certain specifications for the type of debt which you are using, okay, and also with conditions under which you can raise the money. You know, you have to show that the project has gone through a different stage, and at different stage, it will be precise in the financial clause that you will have the possibility to get additional money as planned. Okay, but if you look at it from February to November 10, it's 10 stands for 2010, did. So you see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months. It took 10 months, you know. So it's a rather long delay, okay? But this long delay is explained by the rather high level of sophistication in the type of funding we are going to use. And this is indeed what we are going to see next, okay? But I'm just looking at my watch, and I think it's, I will start with a few comments next time about the SeaPower case, just to stress not reading all this, but stressing the main elements, okay, which I'm not going to do today because I look at my watch and it would be too short, okay. So we'll start from there tomorrow again to try to see what type of financing and how it worked for C-Power before we get into the detail of the instruments which are used in project finance, okay. Well, so I will wish you a good dinner because I'm going to have a lunch, but I think you're going to have your dinner. So have a good dinner and see you tomorrow at the same time. Okay? So see you. And so tomorrow we'll finish with all the fundings, and it will take a bit of time indeed. And I will then after that discuss about your assignment, and we'll go through a case study together so that you have an idea about what I expect from you, okay, in terms of job to be done as part of the group work. Okay? So see you tomorrow and have a good, let's say, Saturday night dinner. Bye-bye.